Hey everyone, welcome back to Finance Friday. It's another special edition of Money Girl, where I answer any burning money question that you have. And today's topic comes from Ashley C. She left a great voicemail. Here it is.
Hi Laura, my name is Ashley C. I cannot thank you enough for all of the incredible content that you share with us. I am a 33-year-old new mom to a little 6-month-old girl. I have a question, well, two questions. The first is trying to figure out how you can sift through all the financial advisors who may or may not be fiduciaries and ask questions of them to know if they're going to be a good fit for you and give you honest advice. I think it would be really helpful to hear how you can trust them through a series of questions that you ask and that you can ask multiple advisors to then compare notes. And then the second question is, if I want to set up my daughter, she's 6 months old, for financial future that enables her to have financial freedom, what are the accounts and strategies you'd recommend so that I can get her up and running? So far, I'm setting up a 529, and I know that there's a lot of perks with new legislation around converting 529 should she not end up going to school. So I'd like to just hear, how to be investing and what kind of accounts to open up. I really appreciate all of the work that you do for everyone who listens. You are contributing to a series of lives that are going to be better off because of the education that you afford us all to have. So thank you again, Laura.
Thank you so much for your generous words and great questions, Ashley. First, this podcast will review several excellent ways to invest for a young child, giving them a secure financial future. Then, I'll discuss how to find the right financial advisor. I appreciate you listening to episode 885 of Money Girl. I'm Laura Adams, an award-winning author, financial speaker, money spokesperson, and consumer advocate. Please reach out to me if you're interested in collaborating for a speaking event or PR campaign. As always, you can reach me using my contact page at lauradadams.com. That's also where you can sign up for my free newsletter called The Money Stack. Subscribers get my Money Success Toolkit, which includes a financial planning workbook and a personal financial statement calculator to assess your financial situation, set goals, and track your wealth. It's a great tool to have at the end of the year and definitely a great one for the new year as you begin planning. If you have a money question, I'd love to feature it here. You can send me an email using the contact page at lauradadams.com or do what Ashley did and call 302-364-0308. Okay, let's talk about 4 ways to make a young child wealthy. If you're a parent, saving for your own financial goals is essential before setting aside money for your kids. Of course, you want the best for your children, but you also need to make wise decisions for your financial future. So if you can genuinely afford it, we're going to cover 4 ways to invest for a young child's future. Okay, the first is to contribute to a 529 plan. Opening and regularly contributing to a 529 college savings plan is a great way to pay a child's future education expenses. So I'm really glad that Ashley mentioned doing that already. It's a good choice since most families will have school expenses. What I love most about a 529 plan is that you can contribute on any schedule that you like, and you can choose investments from a menu of options, like mutual funds or exchange-traded funds. You can use a 529 no matter how much you earn, and the maximum annual contribution limit depends on the plan you choose, but it could be over 6 figures per student depending on your plan. Once you've got money in the account, you can make tax-free 529 withdrawals to pay qualified education expenses. So those are things like tuition, fees, books, required equipment, and room and board. Funds in a 529 plan can be spent at U.S. accredited schools and certain foreign institutions. For example, you could live in Florida, participate in a New York 529 plan, and use the funds to send a child to college in California or even Germany. Thanks to the Tax Cuts and Jobs Act, you can also spend up to $10,000 per beneficiary per year tax-free on elementary and secondary school expenses. So that allows parents to withdraw funds for a younger child attending a public, private, or religious school. Note that funds in a 529 belong to the owner, who is typically a parent, and the account can have one designated beneficiary. That's the future student. And to save for more than one child, you must generally open an account for each of them. However, you can also change a 529 beneficiary to another family member, or even roll over funds to another 529 without triggering taxes. Another new option created by the Secure 2.0 Act allows you to roll over unused 529 funds to the beneficiary's Roth IRA if they qualify for one by having earned income. But there are several restrictions you have to follow. For instance, the 529 must have been open for at least 15 years, and the lifetime rollover limit is $35,000 per beneficiary. Also, you can't transfer 529 contributions or their earnings that were made in the past 5 years. Due to the benefits of a 529, including its tax advantages, flexibility, and high contribution limits, it's an excellent account to save for a child's education. Additionally, your 529 funds are a smaller factor in the calculation for financial aid than some other options that we'll cover. Now, the main drawback of a 529 is that if you withdraw funds for non-qualified expenses, you have to pay income tax plus a 10% penalty on the portion attributed to earnings. So you want to try not to put more in a 529 than you believe your child will need for school. And if you have more money to invest, you want to use one or more options that I'm going to cover next. So the second way to make a young child wealthy is to open a custodial account. In most states, minors can't own investments or any financial products in their names. Therefore, you can only transfer assets to a minor if you create a trust or open a custodial account. There are two types. One is called a Uniform Gift to Minors Act. That gets shortened to UGMA, UGMA, or the Uniform Transfer to Minors Act. That gets shortened to UTMA or UTMA. So depending on where you live, we'll give you access to one or even both of these types of accounts. You can set up UGMA or UTMA accounts at most banks and brokerage firms. These are special accounts that allow you to make investments on behalf of a child, like buying mutual funds or even real estate. The account gets held by a custodian, which can be a parent or even somebody else, but the account is legally owned by the child. Parents can withdraw from a child's custodial account to cover expenses that benefit the child, like paying for the child's education or their health care. The account assets then automatically transfer into the child's name when they're an adult, which is usually at age 18 or 21, depending on where you live. The main benefit of using UGMA or UTMA accounts is giving a child as much money or assets as you like. There are no annual limits or spending restrictions. Plus, a portion of the account's investment earnings gets taxed at your child's income tax rate. Remember, they technically and legally own the account. So that can reduce taxes because it's getting taxed at their lower tax rate rather than the parent's presumably higher tax rate. Since putting money in a custodial account is a gift from a parent to a child, it comes with potential gift and estate tax implications. However, it's easy to avoid triggering the federal gift tax by contributing at most $18,000 annually as a single taxpayer or $36,000 as a married couple if you file taxes jointly. Those are the limits for 2024. Now, you may not owe gift taxes if you exceed those limits. However, additional amounts would count toward your lifetime gift tax exclusion limit. And it's pretty high. It's $13.6 million for 2024. So it's not likely that most people are going to exceed that, but you just do need to keep a record of it if you exceed, the annual limits. Now, the downside of UGMA and UPMA accounts is that once the child reaches the age of majority, parents have no control over how the child spends that money. Also, custodial accounts are considered an asset of the child, as I mentioned, which means they are a more significant factor in the calculation for financial aid than accounts owned by a parent, like a 529 plan. Plus, unlike a 529, custodial accounts don't receive any tax benefits. So a custodial account is a great option if you have more to invest for a child than, let's say, they're going to spend on education and you aren't concerned about losing control of those funds once the child becomes an adult. All right, the third way to set a child up for success is to use a brokerage account. So let's say you do want more control over investments for a young child than you would get with a custodial account. You want to consider opening a brokerage account in your name. You can always earmark money in an account for a child. That way, as the account owner, you can freely access the funds until you choose to give them to your child when they become an adult or at, whatever age you deem appropriate. Or you can simply keep the account funds in your name and make a child the beneficiary of the account if you die. The flexibility is an upside of investing for a child in your own brokerage account. The downside is you're going to be paying taxes on earnings at your tax rate rather than your child's tax rate. Remember that with a custodial account, you're able to pay taxes at the child's lower tax rate. And as I mentioned, you must be mindful of the gift tax rules if you give a brokerage account to a child, no matter their age. All right, the fourth way to ensure the future wealth of a child is to purchase life insurance. In addition to investing for a child, you can also ensure their financial future by purchasing a life insurance policy. In fact, every parent should have life insurance so their minor children would be financially secure after their death. Life insurance is a contract that pays one or more beneficiaries after your death. Depending on your budget and your needs, you can choose term insurance or permanent insurance. Term life insurance pays your beneficiaries a cash benefit if you die within a particular time period, such as in 10 or 20 years. But a permanent life policy covers you for your entire life, and it may also accumulate a cash value that you could tap or grow for a child's benefit. If you're relatively young and healthy, a $500,000 20-year term life policy may cost you less than $300 a year. Now, if you get life insurance through work, that's great, but you may need more coverage. Depending on your financial needs and your family size, having life coverage equal to 10 times your income is a basic rule of thumb. You may need more or less, or if you don't have any dependents, you may not need life insurance at all. Also, remember that if you leave your job for any reason, your life insurance coverage at work ends. Therefore, it's wise to have your own life policy in addition to the coverage that you get through an employer. The downside of buying life insurance is that it typically only benefits your child once you die. However, if you choose a permanent policy that builds a cash value over time, you could tap it to pay expenses, such as for a child's education. So, Ashley, those are my top recommendations for accounts to use when you're thinking about investing for a child or securing the future of a young child. Now, let's talk about your other question about how to find a financial advisor. So before you choose a financial advisor, I want you to get familiar with the following types of advisors based on how they get paid. You kind of need to understand the landscape. You've got commissioned advisors. They earn some or all of their income from third parties as salespeople. For instance, if you buy a mutual fund through them, the advisor may receive a commission from the fund company. And they do have to give you suitable advice, but typically they're not fiduciaries working exclusively in your best interest. However, I want to make sure you understand that many financial products like life insurance is always sold on commission through a licensed broker. So paying a commission to an advisor isn't necessarily a bad thing as long as you understand if there's any potential conflict of interest for, what they're recommending for you. Another type are called fee-only advisors. These advisors earn money from services by charging an hourly rate. They may charge a flat annual rate or even a percentage of your assets under management called AUM. The fee structures will vary by company. For instance, some might charge 1%, some might charge up to 3% of the total value of your portfolio. Obviously, the lower the better. For example, if you have a $100,000 portfolio that they manage, a 1.5% fee means you pay $1,500 yearly for their management and advice. So that gives an advisor an incentive to grow your portfolio because the bigger the portfolio, the larger their fee will be. And there are other advisors who work exclusively with clients just to create financial plans. They may charge a one-time fee that's flat or maybe even hourly, ranging from a few $100s up to a few $1,000s, depending on what you need. Another type are fee-based advisors. These actually combine a commission and a fee-only model by charging a percentage to manage your portfolio and sell investments on commission. Or they may charge a flat fee just to help you create a financial plan, and they'll receive a commission if you purchase any recommended products. Again, what's important is understanding how your advisor gets paid and avoiding any potential conflicts of interest. There are also robo-advisors, which are online investing platforms. They typically offer low-cost management using algorithms and pre-constructed portfolios, typically of exchange-traded funds or mutual funds, based on your risk tolerance and investment goals. They also may provide human advisors for a fee or once your portfolio exceeds a limit. Another aspect of working with financial advisors that needs to be clarified is their various professional certifications and designations, which can, sound really confusing, but I'm going to go through the most common ones. You'll often hear Registered Investment Advisors, or RIA. This is a common designation. These folks are licensed to sell investments, and they're registered with the Federal Securities and Exchange Commission, or SEC, or even state authorities. RIAs must act as your fiduciary, and they could be fee-only or fee-based advisors. You'll also see certified financial planners, or CFPs. They must pass rigorous exams that cover many financial topics, including investing, retirement, taxes, insurance, and estate planning. They must have 3 years of qualifying work experience. They have to adhere to a code of ethics and stay up to date by completing annual continuing education. In addition to CFPs, you might also see Chartered Financial Analysts, or CFAs. They must also pass exams covering investing, accounting, professional ethics, economics, securities analysis, and portfolio management. They must have at least 3 years of qualifying work experience, among other requirements. And you may also see Chartered Financial Consultants, or CHFCs. They also must pass an exam that covers financial planning, investing, taxes, insurance, and estate planning. And they have to have at least 3 years of qualifying work experience. And lastly, most people have heard of Certified Public Accountants, or CPAs. They must pass rigorous exams in accounting, and they specialize in taxes and tax preparation. So which type of financial advisor is best for you depends on factors like how much do you have to invest, the products that you want, and the services that you need, like investment management, business advice, or tax preparation, or all of the above. Some investment advisors only work with high net worth individuals or pre-retirees, but many advisors accept clients with smaller portfolios. So getting back to Ashley's question, how do you find a great financial advisor? This is a really tough question to answer because everyone's a little different. Some people want to work with people in person. Other people are okay having a remote relationship. Ashley, I would say to get recommendations from any of your friends, any of your family members who are working with a financial advisor that they really like. So start asking around. You may be surprised that people will say, oh, yeah, I have somebody that I've been working with and, I think they're great. If you have no idea where to start, there are various organizations that you can visit online and even put in your zip code to return back some of the professionals in your area. So, for instance, you might visit the National Association of Personal Financial Advisors. That's NAPFA.org. There's also the Certified Financial Planner Board. And you might also check the Garrett Planning Network, GARRETT. All of those allow you to search for and verify the credentials of certified professionals in your area and nationwide. Now, once you've got, let's say, a couple people that you think, okay, these 3 people would be good just to start, you can research any advisor's status and their background using the SEC's Investment Advisor Public Disclosure. And I'll put a link to that in the show notes. You can also go to FINRA's Broker Check database. That's at brokercheck.finra.org. Again, that's brokercheck, FINRA.org. That's an important step to ensure that no disciplinary actions or significant complaints were filed against somebody you're thinking about working with. You can also do a Google search for a professional's name plus words like complaints or their name and disciplinary action. So, you can kind of do a little bit of just Google searching to see if anything comes up that looks suspect. Then once you've checked out a few people and they look good, I'm going to recommend that you meet with them either in person or over a video call. And you're looking to interview them just as much as, they're looking to check you out. Now, if you're married or you share your financial life with a partner, you should both meet with a potential advisor together. You want to be prepared to discuss your income, expenses, investments, and your financial goals. I'm going to go through 10 questions that you should ask each advisor and take notes about their answers. Also, maybe jot down notes about their personality and how they made you feel during the meeting. Number 1, what services do you offer or specialize in? If somebody says, that they only work with pre-retirees or that's their specialty and you're a long way from retirement, that may not be a good fit. Number 2, do you have any account minimums to work with clients? Remember, I said there are a lot of advisors that will only work with you if you have, let's say $500,000 or $1 million. So find out right off the bat, what is the minimum and will you satisfy that minimum? Number 3, what types of clients do you typically work with? You want to make sure that they're working with people like you. Are they working with people in, their 20s and their 30s, or are they only working with retirees in their 60s and 70s? Number 4, what is your approach to financial planning? Leave this very open-ended so they can really kind of tell you from scratch how they're thinking about it. Are they somebody that is going to try to really watch the markets for you on a daily basis? Or are they thinking about investing for you over the long term? And the latter is definitely where I would encourage you to be. So get a feel for what are they doing for their clients on a day-to-day basis and how are they going to help you achieve your goals? Number 5, what are your professional certifications? So remember all of those that I went through. Just find out where are they on that educational level. Number 6, how do you make money? Find out, are they commission only? Are they fee-based? Are they a combination? Get them to really clarify for you how they're going to make money in your relationship. Number 7, are you a fiduciary? Are there times you don't act as a fiduciary? So you want to make sure that, somebody is going to be a fiduciary for you 100% of the time. Number 8, how many times or how often would we meet annually? So find out, what is their expectation? Are they looking to meet with you once a year, or are they somebody that's going to want to check in with you quarterly or monthly or even have more frequent contact? Number 9, what information would you need from me to get started? So, if they're not asking you a lot of questions and really trying to understand your financial situation, you want to find out what are they going to go off? What is important to them to get started? And number 10, are you available if I have questions? Or would I need to speak with somebody else? So you want to find out, are they really going to be your advisor and your contact point? Or do they have an assistant, that they're going to make you go through? If so, you want to make sure that you meet with that other person and that they're qualified, etc. So just making sure that the person that you're speaking with is truly going to be your contact anytime you have a question or a concern. Ashley, I hope this helps you give your young daughter a great financial head start and find a great advisor for yourself. Remember, you can always change advisors or firms if a relationship turns out differently than expected. And no matter if you're just starting to invest or you're approaching retirement, using an expert advisor can help you avoid money mistakes, maximize your returns, and follow a sound financial strategy. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast. I want to thank our amazing team. Steve Rickyberg audio engineers the show. Brandon Gachis is our director of podcasts. Holly Hutchins is our digital operations specialist. Morgan Christensen is our advertising operations specialist. Davina Tomlin is our marketing and publicity associate. And Nathaniel Hoops is our marketing contractor.